Welcome to Accounting 101, where numbers tell the story. Hey there, future financial wizards. Welcome to a crash course on some key accounting concepts. Don't worry, we'll keep it light, breezy, and hopefully somewhat entertaining. Think of accounting as the language of business. It's how we tell the financial story of a company. And just like any good story, accuracy is key. We wouldn't want to mislead our audience, would we? Today we're diving into three important areas: inventories, plant, property and equipment, or PPE, and events after the reporting period. These might sound about as exciting as watching paint dry, but trust me, they're crucial for understanding how businesses tick. And who knows, you might even find them strangely fascinating. Or, at the very least, you'll be able to impress your friends with your newfound accounting knowledge. First up, we'll unravel the mysteries of inventories. Then, we'll explore the world of PPE, those big-ticket items that keep businesses running. Finally, we'll tackle the wild world of events after the reporting period, because life, much like accounting, doesn't stop just because the fiscal year ends. So buckle up, grab your calculators, and let's get this accounting party started. Ready to dive into the exciting world of inventories? You bet you are. Let's go! Inventories. They are the backbone of countless businesses, the unsung heroes that keep the wheels turning. They're the lifeblood of many businesses, ensuring that products are available when customers need them. Think of them as the stuff companies buy, make, or plan to sell to make a profit. Without a well-managed inventory, a business can quickly find itself in trouble. We're talking raw materials, work in progress, those half-assembled widgets, and finished goods ready to hit the shelves. Each stage of inventory has its own importance and value. Now, how do we keep track of all this stuff? It's not just about counting items, it's about understanding their value and ensuring they are accounted for accurately. That's where accounting swoops in with its trusty sidekick, valuation. Valuation methods help businesses determine the worth of their inventory, which is crucial for financial reporting. Two popular methods are FIFO, or first in, first out, and weighted average cost. Each method has its own advantages and can impact the financial statements differently. FIFO assumes those items that came in first are sold first. This method is often used in industries where products have a limited shelf life. Think of it like your fridge. The oldest milk gets poured first, hopefully before it expires. This helps in reducing waste and ensuring freshness. Weighted average cost, on the other hand, averages the cost of all items. This method smooths out price fluctuations and provides a more stable cost basis. What happens when the stuff you're trying to sell is worth less than you thought? Market conditions can change and products can lose their value. Maybe those once trendy fidget spinners are now gathering dust. Inventory that doesn't sell can become a financial burden. That's where net realizable value, or NRV, comes in. NRV helps businesses determine the true value of their inventory in the current market. Basically, it's the estimated selling price minus any cost to get those items out the door. This ensures that the inventory is valued at a realistic amount. If NRV is lower than the cost, well, you might have to take a hit on your profits. Ouch! This can be a tough pill to swallow, but is necessary for accurate financial reporting. Finally, transparency is key in accounting. Clear and honest reporting builds trust with investors and stakeholders. Companies need to disclose what method they use to value their inventory and any write-downs they had to make. This transparency helps in making informed decisions. It's all about giving investors a clear picture of what's really going on behind those balance sheets. Accurate inventory valuation is crucial for understanding a company's financial health, because as we all know, honesty is the best policy, even in accounting. Transparent and honest accounting practices ensure long-term success and credibility. Let's talk about the big guns: plant, property and equipment, or PPE. These are the backbone of any industrial operation, the heavy lifters that keep the wheels of business turning. This isn't your grandma's antique china, it's the heavy-duty stuff businesses rely on. We're talking about the essential assets that drive production and operations. Think factories, machinery, vehicles, and even that fancy espresso machine in the break room. These are the tangible assets that you can touch and see, and they play a crucial role in day-to-day business activities. Basically anything that's tangible, used in business operations, and expected to last longer than a year. These assets are not just for show, they are integral to the functioning and efficiency of the business. Now, acquiring PPE is a big deal, and accounting needs to reflect that. It's not just a simple purchase, it's a strategic investment that requires careful planning and financial consideration. When a company buys a shiny new piece of equipment, it's not just about the sticker price. There are multiple layers of costs involved that need to be accounted for. We're talking about all those extra costs to get it up and running. Shipping, installation, those pesky consultant fees. These additional expenses can add up quickly and must be included in the total cost of the asset. Even the cost of dismantling and removing it at the end of its useful life needs to be factored in. Talk about planning ahead. This ensures that the company is prepared for the eventual replacement or disposal of the asset. Once we've got the initial cost sorted, it's time to decide how to depreciate this asset over its useful life. Depreciation is a critical aspect of accounting for PPE, as it spreads the cost of the asset over its useful life. Think of depreciation as the gradual decrease in an asset's value over time. This reflects the wear and tear, usage, and obsolescence of the asset. Two main models come into play: the cost model, where the asset's value decreases evenly over its life, and the revaluation model, which allows for changes in value based on market conditions. Each model has its own set of rules and implications for financial reporting. Depreciation can get a bit complex with different methods to choose from. The choice of method can significantly impact the financial statements and tax liabilities of a business. The straight line method is like a slow and steady marathon run, depreciating the asset evenly over its life. This method is simple and easy to apply, making it a popular choice for many businesses. The accelerated depreciation method, on the other hand, is like a sprinter out of the gate, taking bigger chunks of depreciation in the early years. This method can be beneficial for businesses looking to reduce taxable income in the short term. Choosing the right depreciation method depends on various factors, including the nature of the asset, the business's financial strategy, and tax considerations. It's a decision that requires careful analysis and expert advice. In conclusion, accounting for big investments like PPE is a complex but essential part of managing a business's financial health. It involves not just the initial purchase, but also ongoing costs, depreciation, and eventual disposal. Proper accounting ensures that the business can make informed decisions, plan for the future, and maintain financial stability. Section 4. Events after the reporting period. Because life doesn't stop at the fiscal year end, the world keeps spinning, and so do the wheels of business. Hold on to your hats, folks, because the accounting roller coaster doesn't stop just because the fiscal year is over. In fact, some of the most critical events can happen right after the year end. Events can happen after the reporting period that could significantly impact a company's financial statements. These events are crucial because they can alter the financial landscape of a company. Talk about a plot twist. Just when you think you've wrapped up the year, something unexpected can come along and change everything. These events fall into two categories: adjusting events and non-adjusting events. Understanding the difference is key to accurate financial reporting. Adjusting events and non-adjusting events. Let's break these down a bit further. Adjusting events are those pesky occurrences that provide evidence of conditions that existed at the end of the reporting period. They are like the ghosts of the past year coming back to haunt you. Think of a customer going bankrupt after the year end, but before the financial statements are out. This is a classic example of an adjusting event. Bad news for the company, and definitely something that needs to be adjusted in the accounts. The financial statements must reflect this new reality. Non-adjusting events, on the other hand, are like those unexpected guests who show up after the party's over. They weren't part of the original plan, but they still need to be acknowledged. They relate to conditions that arose after the reporting period. These events don't change the past, but can influence future decisions. For example, a fire destroying a warehouse after the year end is a non-adjusting event. Tragic, yes, but it doesn't affect the previous year's financial statements. Instead, it will be disclosed in the notes to the accounts, providing transparency to stakeholders. Deciding whether an event requires an adjustment or just a disclosure can be tricky. It requires a deep understanding of the circumstances and the potential impact on the financial statements. It's all about using your professional judgment and applying those accounting standards diligently. This is where the expertise of an accountant truly shines. Remember, the goal is to present a true and fair view of the company's financial position. No sugarcoating allowed. Transparency and accuracy are paramount in maintaining trust and integrity in financial reporting. Section 5, that's a wrap, but your accounting journey's just begun. And there you have it, folks, a whirlwind tour of inventories, PPE, and events after the reporting period. We've covered a lot of ground, from valuing those fidget spinners to depreciating those factory machines. Remember, accounting is all about painting a clear and accurate picture of a company's financial health. It's about telling the story of a business through numbers. And like any good story, it needs to be accurate, reliable, and engaging. We've just scratched the surface of the vast and fascinating world of accounting, so keep exploring, keep asking questions, and keep those calculators handy. Because in the world of business, numbers are power, and understanding accounting gives you the power to make informed decisions, analyze financial information, and maybe even start your own business empire. And who knows, maybe one day, you'll be the one explaining these concepts to a new generation of accounting enthusiasts. Until then, keep learning, keep growing, and keep those accounting fires burning bright.